live stream. It's been a couple weeks since I've had the opportunity to hop on and talk about what's going on in the markets, but nonetheless, we are back in the cockpit here, and it's good to be with you. It's been an interesting couple of weeks in all markets, whether it's stocks, bonds, commodities, crypto, or what have you. So let me go ahead and share my screen, and we can get right down to business here. Start off by looking at the S&P 500. You can see that we rallied to a new high last week, but we basically were rejected at resistance in the 40, 50, $4,200 area, and a lot of other traders and technical analysts have pointed out, this downward sloping trend line here. We were rejected in that area as well, and really, even if we cleared that trend line, it really wouldn't necessarily mean that the bear market is over. Rather, I would view that as the market saying that the rate of descent is no longer in effect. So in order to confirm that, bulls have shifted the tide, I'd prefer to see a close above resistance here in the 40, 50, $4,200 area. But, what concerns me right now in the short term when it comes to stocks is it looks like we're starting to break below this ascending price channel. And these are known to be continuation patterns, which means they tend to resolve in the direction of the underlying trend. And we can see very clearly here that year to date, the trend in stocks has been down. I would characterize that as an intermediate term trend. In the short term, since the October lows, we have had a short series of higher highs and higher lows. So, we have some conflicting trends, I think, but the key level that I'm watching in equities right now is at 38, 3,900. If we start to close below that zone in stocks, I think it pretty much ruins the party for bulls, and we could be on a straight shot down to 3,000, 3,200. Now, couple factors here. First of all, seems like everyone turned bearish in a matter of 3 days. So, but I do want to point out that the RSI indicator here formed at a high. Well, we formed the high in stocks right as the RSI indicator stalled out in corrective rally territory between 40 and 60. So we've talked about that before, and how we wanted to see an overbought reading like we did. It didn't mean much back in August, but that was kind of an exception rather than the rule. So the fact that bulls weren't able to print an overbought reading on the RSI indicator, I think, is a sign that gives the bears a little bit of an argument, or more of an argument, I think, going into the holiday season. But, that's the title of today's talk. Is the Santa coming to save stocks, or is a Christmas crash coming? So I'm actually not in the camp of a Christmas crash. The reason why is liquidity conditions have actually improved in the last couple months. If you look at credit spreads, a couple other metrics, Fed's starting to hit the brake on the pace of rate hikes. That's to be expected, but they're still hiking, right? Yield curve is very inverted, but I think that there's a lot of bearish sentiment out right now, and if we don't close below 38, 3,900, that the bulls still have an argument to be made. This time of year is also very seasonally bullish for stocks. The Santa Claus rally is actually the last days of trading after the Christmas holiday and the first 2 trading days of the new year. And if that period generates a positive return, it has a very high correspondence to basically a nice bellwether for the year ahead. Now, we actually had a positive Santa Claus rally return last year. Or basically the Santa Claus period for 2021, 2022, but you can see that didn't work out. So it's important to remember all we have in markets is probabilities, and that's what we're going off of. So let's see. Let's take a look at the NASDAQ here. NASDAQ continues to underperform to the down, leading to the downside and underperforming in general. That's to be expected. Really no surprise there, given where we are in the potential macroeconomic shifts going underway. Dow still leading pretty much flat on the day. Still a big fan of mid cap and small cap stocks. Let's see here. Mid cap is pretty much flat on the day. Small cap flat on the day as well. But I do want to point out, the whole commodity and the inflation, scare. Let's take a look at USO, the United States Oil Fund. And, I think that crude oil could fall to $60, $65 a barrel. And, we're already seeing inflation readings come in below expectations. And I think that's a really good sign in the short term that, the Fed has successfully destroyed demand to an extent. So now they're going to keep raising rates and the yield curve is going to keep inverting. But when it comes to USO here, I'm kind of in the camp that we could see a drop into the $54, $56 area But I do think that a low of significance is upon us probably in Q1 of 2023. So keep that in mind as we look at another sector, another asset class, that being bonds, and look at interest rates. Interest rates are coming down, especially the longer you go out on the yield curve. So this has a lot of ramifications as we, are basically a quarter away from 2023 home buying season. So what would happen to real estate? There's a bunch of headlines out today that these large institutional REITs are suspending redemptions. Yeah, that's bearish news. But remember, markets discount future events. What happens if interest rates fall into the March-May period? Is that going to be a headwind or a tailwind for the real estate market? I argue that it would actually be a tailwind for the real estate market because there are signs that real estate has slowed and the last 3 to 5 months or so, but not a lot of home buying goes on, at least at the residential level in the winter. It still happens, but it's not the peak season. So if rates actually come down, let's look at the 30-year. We're looking at the 10-year here. Let's look at the 30-year. If the 30-year Treasury comes down to 2.8, 3.0, and then mortgage rates, let's say, come down from being over 7% to 5%, I think that's actually that will give buyers some impetus in the home buying season ahead. So, I think perhaps, and look here, we have an oversold reading, the RSI indicator in the daily on the 30-year Treasury yield. So remember, doom and gloom, everyone talks about buying when there's blood in the streets, like Warren Buffett says, but when it actually comes around, everyone's usually paralyzed in fear. So let's talk about some other markets that have been on our radar. We've been talking about Turkish equities, down 3% today, but it's been a stratospheric rise. It was up like 40% in a matter of a couple months. Let's go ahead and zoom out here and take a look at the weekly chart for the ETF. So we started monitoring this a few months ago, absolutely skyrocketed. So this has been a good trade. We'll look for some consolidation or digestion near the highs here, formation of a higher low. But, this market rallied pretty quickly. So at this point, some chips should have been taken off the table. We did reduce our long exposure here, but I'm keen on seeing support holding that $29, $30 level for now. But going into 2023, I think gold and silver offer a lot of value right now. Take a look at the gold mining ETF. GDX just broke out from a rounding bottom formation. And this is very significant because we note that basically since 2018, there's been a really strong positive correlation. It's not 100%, but it's called around 80% or so between bonds and precious metals, meaning that when interest rates fall, precious metals tend to go up. So we talked about how crude oil could be in correction mode and how that's actually bullish for bonds, meaning interest rates could fall because crude oil is the primary driver of inflation expectations. So if crude oil prices are retreating, that means that inflation expectations are going to come down, which means bonds can rally. And if bonds and precious metals are positively correlated, this provides actually a nice environment for precious metals to stage a bull run. And I think this is not something to be slept on, especially as you look at the commodity complex. A lot of these commodities, whether it's grain markets, wheat, corn, beans, or oil, are down over 30% from their highs that were registered in March of this year. Now, precious metals are not the same. We can't look at precious metals through the same lens as other commodities. Yeah, obviously there's supply and demand factors that impact other commodities as well. And there's been a broader commodity shortage that has helped push prices higher. But I think the big story here is, metals have a monetary property to them. I'm not one of those people that say gold and silver should be the reserve currency, but they do offer a hedge to counterparty risk. And whenever uncertainty rises, whether it's geopolitical or monetary, metals tend to do well. And so I think that metals are presenting a significant opportunity, especially if interest rates fall for the next 3 to 5 months here. I think gold and silver can be really lucrative. And especially if we're looking at further weakness in stocks, if we close below that $3,800, $3,900 level in the S&P 500, precious metals don't really have the strongest correlation to equity performance. In other words, they're a non-correlated asset. And when you see that type of volatility in equities, it's nice to have a significant allocation to a non-correlated asset in one's portfolio. So obviously bonds can fulfill that role, but this year they have been positively correlated. That is, stocks and bonds have generally traded in the same direction this year. That's not always the case. In fact, treasuries often act as a flight to safety trade when equities are in turmoil, but that has not been the case. So I think this is pointing to a broader macroeconomic shift. And my argument is that the days of low interest rates are pretty much behind us. We had a 40-year bull market in bonds, 40-year bear market in interest rates. And I think COVID ended that in March of 2020. So at some point we'll need to see, that correlation with metals and bonds decouple. But let's look at silver here, because I'm actually more constructive on silver than I am on gold from a valuation standpoint. And in turn, I'm actually most constructive on silver miners. And, I get this question a lot. What about physical metal versus equities? Well, you have to factor in the liquidity factor, but also think about the premium that you have to pay on to get physical delivery. A lot of times if you're buying silver, $21 an ounce, let's call it, and the broker's charging you a $3 premium, silver has to go up $3 just for you to break even. So I like the stocks, the miners, because they're liquid. There's pretty much no cost to get in and get out. Let's look at the gold silver ratio here, and you'll see how silver is very much at a bargain compared to gold. And let's actually zoom out so we can actually see on a historical basis that silver is still really cheap to gold. You can see that when the bull market in metals ended in 2001, silver was steeply valued compared to gold. In other words, gold was inexpensive compared to silver. But in 2020, silver was very much inexpensive compared to gold. And I think that is a major theme that we need to focus on as we build our bullish metal thesis going into 2023, because I think that silver has a one-way ticket to 27.50. And if that starts to clear, I wouldn't be surprised to see silver prices in the mid to high 30s by early next year. So gold, keep in mind, has already tested and exceeded its high from 2011. Silver has yet to do so. And I'm not saying, oh, look, one did one thing, so the other has to do the same thing. That's not how markets work. But silver and gold are married at the hip, so to speak. And when you look at their ratios to each other, I do think there's a tremendous opportunity building in silver right now that shouldn't be ignored. So that pretty much takes care of what I wanted to talk with you about today. I'm going to make it a point to be doing these during the holiday season, since obviously we're not in farming time right now. So I have a little more time to spend looking at charts and sharing my thoughts with you. So if you enjoyed this, would encourage you to check out some of our work at www.mmacycles.com. Also publish quite a bit with Benzinga, our friends over at Benzinga, www.benzinga.com. So thank you everyone for watching. It's great to be back here again, and I will be back sooner rather than later.